Perfect. Thanks, Michael. And two more Michaels here. Well, hello and welcome, and thanks everyone for joining us for our Qnary webinar series, where we celebrate executive thought leadership in the enterprise. Today's topic: how COVID-19 is reshaping the financial markets and how executives should communicate. We're delighted to have Michael Venuto, co-founder and chief investment officer at Toroso, as well as Michael Spellacy, global industry leader for capital markets at Accenture. I'd love to give each a moment to introduce yourselves. Michael Spellacy.
Yeah, Ray, thanks so much for allowing us to join here today, and also to my fellow panelists. Michael, nice to see you here again online. I suppose we're all Zoomsters these days, or Zoomers, or whatever we call ourselves now. I've spent 25 years in the capital markets in a broad range of executive, investor, and advisor consultant roles, and I'm delighted to have a discussion with you today and share some perspectives.
Okay, I guess it's my turn. Mike, great to be with you today. My name is Mike Venuto. I'm the CIO and co-founder of Toroso Investments. We're an ETF specialist firm, and that's why you see in the background our ETF Think Tank. That's kind of our public-facing research engine where we tell the world everything that is going on in the ETF industry. We're behind a lot of the innovative ETF stuff that you've seen out there. We're behind the SoFi ETFs. We helped bring to market the first ever zero fee funds with SoFi, the blockchain ETF, a lot of fun stuff like that. But we're not here to talk our products. We're here to give insights on how to be a financial executive in the COVID-19 world. So Ray, thanks for having us.
Oh, thank you so much, both. And we're certainly living in a historic moment that will be remembered for generations to come. A lot has been spoken about the impact of COVID-19 in the economy. And in today's conversation, we really want to focus on what's next, how this pandemic is reshaping the financial markets as we all know them, and also very important, how you as financial leaders should communicate in this era. Well, some economists have been kind of like calling this crisis artificially induced by the deliberate choice of people and governments. Fed Chair Powell himself said that there's nothing fundamentally wrong with the US economy. And also former Fed Chair Bernanke said back in March that there was a very sharp recession followed by a fairly quick rebound. So going to the first questions, what can we expect from the markets now that the US economy is reopening? Michael Spellacy.
It's a tricky one, Ray, to be very direct. Everybody wants a crystal ball, right? And everybody wants a prognostication of X or Y, and I'm certainly not in that business. But from a perspective viewpoint, and I think perspective really matters, I think you summed it up around everybody wants to know what's next. I think we should take pause to really understand what is actually happening here. And while history doesn't, certainly repeat itself, it does rhyme. And I think that there are some great lessons from history around crises, financial crises or otherwise, and that we can really take tremendous lessons from in terms of, one, the human's desire to return to relative levels of normality is overwhelming. Everybody wants to go back to relative levels of normal, whatever that means and whatever form that means, whatever country you're in. And we see a lot of conversation around the discussion of the shape of the recovery. So you hear lots of, verbiage around, is it a V, is it a W, is it an L, is it a U? And I really don't think the shape actually ultimately matters right now. I think what matters is around stabilization before you can reconfigure and before you can actually recover. So I think that the world on a global basis, regardless of the puts and takes that have taken place, has done quite a strong job of stabilizing what was a very short and sharp shock to both aggregate demand and aggregate supply in a very specific format, and tremendous fiscal stimuli on a global basis to try and give some element of stability and prevent what is a humanitarian health crisis from becoming a existential credit crisis and all that entails. What we can expect from the economy or the markets as the US reopens, which it will reopen in whatever format that takes, is that the markets are obviously ahead of where the potentially existential issues are right now. There's an expectation that we will go back to the same type of growth rates and the same type of trajectory that we were on. I'm not so sure that's the case. What we are seeing in terms of the value impacts across the industry, sector by sector, industry sector by sector, is that we are really entering into a very sustained recessionary oriented period where demand has fallen off the charts. There is a very, very large level of supply, potentially overcapacity in lots of industries. And what was trends before this impact around pervasive digital in retail or pervasive digital in XYZ industry has just been accelerated by this crisis. And there's going to be a shakeout. There will be in some format a set of solvency issues that will come in certain industry sectors. And we can expect a set of variables which don't look very healthy going into Q3 and Q4, which I think will shake the market in some format. Now, some will argue, and we can argue the pros and cons, whether it's priced in or not. Just as much as we didn't have this type of variable in our scenario set, we certainly don't have the variables of entire industries being set apart and alight either in our scenario modeling in the financial markets. So I think we've got a long road ahead of us, and the markets will be range bound in some format for some period of time, and we will get some very bad or unhealthy news about certain industries as we go forward. But on the flip side of that, I'm not a doomsayer. I really believe optimistically that we will rebound, recover greater than what we were before. And it will take a newer format than where we were before. I think suddenly, things get into very high relief quickly around what matters to people, what matters to economies, what matters to industries. And I think great optimism from that, and I think people are seeing that today.
Thanks, Michael. And you were talking about talking about specific industries, talking about how we're going to rebound, how some industries are going to come back stronger, how some others are going to be different. Leads to the following question. And I know Mike Venuto and his team over at Toroso Investments have been writing about lately about what are the biggest opportunities in the market as we reemerge from this pandemic.
Yeah, so I would say, feeding off of Michael's comments and going into this question, we see the volatility as well. Michael kind of said the markets are leading the economy. I would say a little bit more extreme. They're almost disconnected. What is happening on Main Street versus what's happening on Wall Street seem to be two different worlds. We were speaking with Jim Bianco of Bianco Research a week or two ago, this 90% economy idea, that in a year from now, if everything reopens, we could be back at 90% of where we were 4 months ago. Well, that would still be a Great Depression. And it's pretty optimistic to think that we're going to get there. So the way we see it is, with all the absurdity out there, we could see new highs this year and new lows, maybe twice for both. So with all of that unknown, you've got to get to things that you can know, right? And I think this leads to the question Ray's really asking me: where are these opportunities? When you don't know how and when the market and the economy are going to come together, when you don't know whether or not there's a second wave, a third wave, when you don't know if people will return to restaurants, you got to fall back to the opportunities that you can quantify. And so we've quantified them into two buckets. We call them zombies and bookshelves. So zombies are industries within our markets that without government intervention, and I mean more than what we've seen, and we've seen unprecedented government intervention, but without the taxpayers saving the shareholders of airlines, of mall operators, of certain real estate companies, certain oil service companies, we don't see how those shareholders are held to be true and keep their value without further and further government intervention. That's not to say there won't be airlines. That's to say there'll be prepackaged bankruptcies. You know, if we think back to 2008, they didn't save the shareholders of Lehman Brothers. They didn't save the shareholders of GE and AIG and Ford and Bear Stearns. They saved the businesses. And when the reality of these numbers come, I don't want to own those zombies. Then the other side is the bookshelves. If you notice on TV, everybody's on Zoom now. We all have backgrounds, but almost everybody's got a bookshelf in their background. Who knew there was a bull market in bookshelves? The bookshelves to us are companies that were part of the mega trends that were already occurring. We're already moving towards more decentralization, more gig economy, more contactless payments. We were already looking at germ scores. The whole world was already moving away from that 9-to-5 office. And this process accelerated it. So Ray, I know I gave you a long answer, but what I'm getting to is look for the trends of the new economy, not the old. We're not going back to where we were 3 or 4 months ago. What's going to be the growth, what gets us out of a recession, are the growth of new economy companies.
Thank you.
Yeah, I would like to just add just one point to it. I think, Michael, I appreciate that. I love the zombie and bookshelves analogy. I think what's interesting is, you know, as we all have bookshelves behind us, I guarantee you we all have different types of books on those shelves. And so what's very interesting is that, you know, perspective and knowledge and understanding of dynamics, I think really matters. It's mattered before this situation. I think it matters more after this situation. And I think what is interesting is that the role of the alternative markets, in particular private credit and private market participants, will be, I think, excessively large going forward. They've often filled in from where the void was left by traditional banking and otherwise. I think you're going to see that play out again in these particular economies and particularly industry segments, where the substitutions of what is by necessity will take place of what to move from debt to equity in some of these companies, in some of the books which sit on the shelf, which will hopefully emerge going forward. I think will be a very big part of the markets and the opportunities going forward in those markets.
I agree.
Thank you. Thank you so much. So, you know, also as we are kind of like opening back up and we're looking at opportunities and how the economy is trending, what are the key indicators that you guys follow in order to assess how this long-term economy is looking and is trending? Michael Spellacy.
Yeah, I mean, I think, you know, and I can't wait to hear Michael's view on the other Michael's view on this, is that I think you have to get beyond the basic indicators in the markets. I think, you know, market ranges, market volatilities, stock market indices, I think they'll all drive you crazy in this particular environment. And they don't give you a real separation of signal from the noise. I think you have to get to what is the signal. What is the signal of, to the prior analogy of the bookshelves? How pervasive is digital in XYZ industry? So there's a great example. I was just talking with a very senior executive in the retail segment recently. And what he told me was, he's like, Michael, for 10 years in an up market, everything was hunky-dory. And in 10 down trading days, only 10 of the down trading days, we had 7 major retailers in active bankruptcy discussions. Something fundamentally wrong with those business models. And so the question here is a business model issue. What is the indicators that give you an impression or an indication, a leading indicator of the movement to digital, the movement to cloud, the movement to adoption of world-class elimination of excessive manual activity? How many times have you got a bank or a financial services institution and being asked for the same information more than once? I mean, it's probably all the time. There's no reason to ask for information more than once in the real economy, in the world economy, in the bookshelf economy, digital, pervasive digital. So the indicators of what is a world-class business model, I think, is where you have to look for real signal versus getting confused with all the noise about the ups and downs and puts and takes.
Yeah, I would agree very much. Like, would you want to own today Simon Property Group, the largest mall operator in the world, or Shopify, the largest digital mall in the world, right? Like, it's understanding the difference between those zombies and those bookshelves or innovators. You know, in terms of other economic signals, from a broad market perspective, to me, there's only really one that you can look at this point, and it's what is the government going to do? Because that's going to dictate everything else, right? So, like, I totally see where Michael's going with the business characteristics, and we're 100% on the same page. In terms of the broad markets going up or down every day, it really is, are things getting better with this virus, and is the government going to print more money? And that creates a whole million other problems for us that you're going to have to worry about in the future. I will say, like, we do manage a mutual fund that uses signals to go up and down the market, and it's worked. We're up almost 50% this year. And it's different, though. We're not picking a signal to say go in, go out. We're saying, what are the conditions that favor a downturn versus a risk on versus risk off? And those signals can be wrong a lot. They can be right a lot. What happens is when you have a lot of swings, if you get 51% of them right, you get good returns. So there's a ton of unknowns, but I totally agree. Owning the companies that are the new economy, that are business models, that's a lot better than almost any signal out there. It's no longer a beta rally. You actually have to decide what to own. If you buy the S&P 500, you're going to own some airlines. You're going to own, well, you won't own cruise ships, but you're going to own mall operators. I'd rather own Shopify.
Yeah. Thank you, Michael Venuto. Michael Venuto, in one of your most recent posts, you were talking about how the U.S. government buying corporate bond ETFs. You find that moment as a watershed moment for the industry. What does the outlook look like for the ETF industry post-pandemic, if anything has changed from earlier this year?
Yeah, so the ETF industry is really stayed very strong through this. We've done some research on our blogs at etfthinktank.com about how after every downturn, ETFs see massive flows. The first time ETFs took in assets more than mutual funds was in 2009, following the crisis then. So I think the industry is well positioned. We call them client alignment factors. Our transparency, our liquidity, our lower cost, the tax efficiency, it's very well set up for people when they want to come back in or want to average in. The Fed using ETFs as their chosen vehicle to help prop up assets, that's another, call it badge of honor for the wrapper, the structure. Now, that doesn't mean that that's a sign that it saves the economy or saves broad-based ETFs. I don't advocate just using the cheapest things anymore. You got to look and see what you own. As an example, in Japan, the Bank of Japan has been buying the ETFs of that market for years. They kept it alive. Is it really propping it up and causing the growth? No. So to me, the next wave of ETF growth out of this, again, is about innovation. Give me the things that are the new growers, the new economy, not just an index where 15% of them, of companies in there, be bankrupt. That's the idea.
Thank you so much. Michael Spellacy, given this times of pandemic, it's always easy for businesses to go back and focus only on the bottom line and forget about their long-term sustainable goals or
Right.
ESG goals. You wrote a fascinating article on Forbes recently. What's your perspective? Not only from a perspective of an asset manager, but also as a businessman who is kind of like running a P&L and trying to make it through these tough times.
Look, I mean, I think that I think at a human level, at a moral level, at an ethical level, we have responsibilities to be authentic producers of capital and capital stewardship, and stewardship of the social, environmental, and governance aspects of businesses is by necessity a part of that. And I think that that great realization has been occurring for a very, very long period of time. I think the accentuation of it is clearly has occurred in the last several sets of years. And I think it's a great thing for business. It's a great thing for society. It's a great thing for shareholders. It's a great thing for stakeholders in broad aspects of our economy. It's no surprise that, a pandemic like the one that we're in puts a very big suddenly an apostrophe in people's heads around, oh my God, it's like, suddenly the grocery deliverer or the guy that's driving the truck is incredibly valuable all of a sudden. Well, they were always valuable, right? That business was always valuable. And, the dynamic of the separation of the highs and the lows has been accentuated by this for sure. It's definitely pointed out large aspects of inequality or inequity. And that has always been there. I mean, since Noah boarded the ark, if you're being facetious about it, of course that exists. And the question of will it persist is another question. So the persistence of driving world-class businesses, world-class engaged customer experiences, world-class dynamics, that's what we have to look to in the future. And ESG as the moniker of that component set is absolutely intact. I mean, the vast majority of capital allocators today, in particular the really dynamic asset owners who own the underlying assets, have ESG at the core of their agenda. And it will become a bigger part of the agenda versus a lesser part of the agenda as we move through this type of crisis set. And expect more, expect wider, expect deeper sustainability solutions, expect the movement away from, ESG being wrapped up as, I'm going to be facetious for a second, just to polarize it. It is not just about, farms and trees and insects, it is, and whales. It's about what we are as human beings. It's about what we are as an economy. It's about what we are as a future of our society, the future of our children, of their children, of the dynamics of the world that we live in. And the innovation that spins around it today and moves around it has become faster, and I think better in terms of ETF product, in terms of asset management product, in terms of banking product, and services. And I think we'll see more of it. I really do. And that's not a pipe dream. It's here today. It's a reality today. It's a reality in the executives that I face off against. It's a reality in the agenda of our world. Will be a better place to be and engage in going forward. I really believe that to be the case.
Thank you. Thank you so much. That's great. Another question, just shifting gears, the financial industry has always lagged behind when it comes to digital transformation and technology adoption. There's always been concerns about compliance, security, etc. Certainly this pandemic has pushed that agenda, has accelerated that agenda dramatically. What are the biggest challenges that you feel the capital markets, the financial industry facing nowadays?
So which one would you like? You want me to take that one, or you want Mike?
Mike Spellacy.
Which Mike?
Mike Spellacy.
Yeah, maybe I'll start, Michael, and then you can jump in. Look, I think that the digital transformation journey, and it really is a journey, has been relatively slow compared to other industries across the financial markets. And there's no doubt that that acceleration is well underway. For the last 3 or 4 years, it's been, probably the defining characteristics of the financial markets, in particular in asset management, wealth management, and banking, moving into the broader capital markets. Data, technology, pervasive digital is the nature of the day, is the order of the day. It has only been accelerated by COVID. I mean, the acceleration is enormous via COVID. And I honestly believe it's a great thing. It's a tremendous thing. Now, the challenge, and a very authentic challenge for executives, is the difference between, in the COVID times, protecting the business for the sake of the business, balanced with protecting the business for the sake of its people. And that balance will have to be threaded very, very carefully, because by the very nature of a digital transformation process, you have a replacement of technology and people, replacement in either side of the equation, depending on where you go. And that challenge is one that's a very fine line to walk in this current time, will be a fine line to walk for the next 2 or 3 years, and an even finer line to walk as we go forward. But the transformation process of digital in the financial services industry is the order of the day. And honestly, it's about time. It's about time that our financial wellness, our financial dynamic, our financial view is enshrined just as much as it is in many other aspects of our lives, in other parts of the world, in other industries where we interact on a much different basis.
Mike Venuto.
I mean, I would agree 100%. Most of the time, financial firms historically have held their information close to the vest because it's that IP that they monetize. The reason I was so attracted to these ETFs is their transparency forces you to be vocal. We've seen it with Catherine Wood of ARK, for example. Rather than run away from explaining why she owns something, she publishes it every day and sends everybody an email who signs up for it. Right? Like, embracing that transparency and doing it in a compliant way is the key to furthering an audience. And it's more necessary than ever, right? Like, we've had a company here at Toroso, an ETF Think Tank, 21 people, 7 different states. We have to do digital meetings like this all throughout the week to keep everybody together. We've been operating like it's COVID-19 for 8 years. Right. So it's been interesting to watch others have to respond. Now, because of that, we're able to jump ahead and over communicate, right? Like, I know the most important thing when the conferences are taken away, when the golf balls and dinners are taken away, when the happy hours are taken away, is how do we stay connected? So, we do meetings like this with 75, 80 advisors a month. Every Thursday, we do a happy hour on Zoom. There's no agenda. We just invite somebody to come sit down, and 200 of our closest friends, open to the public. It's called getthinktank.com. Lets us all sit there and over communicate. We're over communicating to our clients, to our prospects, and to Mark's point, that multi-stakeholder concept within the ESG, our employees, our teams, their families, right? Like, all of that is very, very important in this shift to the digital world. And this was going to happen either way. It's just accelerated by the pandemic that we're facing.
Thank you. That's great. During these times of crisis and uncertainty and fear, that one can say that best leaders can do is to communicate and communicate clear. Here at Qnary, a social media management company for executives that we see that across the board. Certainly the financial space has always been a little bit tricky. How, during this crisis and post this crisis, how do you think financial leaders should be communicating, moving forward? What's your stand on that, Mike Venuto?
It's where I was going. It's overdue. Like, people, I keep hearing people have webinar fatigue and Zoom fatigue and Twitter fatigue, and I think it's all ridiculous because every time we put something out there, we're getting more and more engagement than ever before, right? People are wanting to hear from us, from everyone. They want to know what's going on. They want information. So we post a daily blog at this point on ETF Think Tank. Then we repurpose that through all of our multiple social media accounts, through all of our team members. We're big believers in not only having the brand identity of the company, but also of the contributors. So each of our contributors are focused, meaning contributors meaning thought leaders or influencers within our partnership teams. I think social media has such a huge impact now in finance that people cannot ignore it anymore. I mean, I'm watching institutional firms that would normally be scared to death of this, that run $500 billion, now running promoted Twitter ads because they can't go to a conference and buy golf balls anymore.
Yeah, absolutely. Mike Spellacy.
Look, I never use the golf ball. I love to play golf, and the golf balls you always get at these conferences are useless, right? I mean, they're damn things. they take points off, like rather than giving you points. But I think the real issue here for me as a financial executive is leadership matters, like real leadership matters. And leadership by its very nature, I mean, we can wax poetic about this all day long, is authentic. And authentic is vulnerable, right? The vulnerability of real leaders is about balance and perspective. In uncertainty like we're in, you're getting information all the time. You, honest to goodness, you don't know what to do in certain times. And it's okay to say, I don't know, but I'm going to help you and others and us to figure it out. So the pragmatism of real leadership in an authentic, vulnerable, transparent way that brings the best of people together, I think is about the essence of real communication in this time and for the majority of time that we will face going forward. And I think how you bring subject matter experts and teams and knowledge and perspective and engage points of view and balance it in a way that deals with uncertainty, that's unfolding information, and has very low ego involved is a real dynamic. And especially on Zoom, especially when you can't be face to face, is to be open enough to say, I don't know. I don't know. But what I do know is that I respect your opinion, I respect your viewpoint, and we'll come back together and figure out how to deal with this going forward. I think that's a much more engaged style of communication. It's a much more engaged style of leadership, and it's a much more pragmatic way of dealing with the uncertainty that this crisis presents, plus any other crisis will present in the future.
Perfect. Thank you so much. There's one last question, and I'm going to ask if we can be as brief as possible because I know we're a little bit past the time and I want to leave some time for questions. But the last question is, from all of this madness, all of these chaos and, challenges, what's permanent and what's temporary? Mike Spellacy.
Look, I mean, I think our consumption habits are permanently changed by the knew that toilet paper will be the next commodity. I mean, our consumption has definitely changed, but I think it's a much bigger part of a trend in humanity around what is holistic preparedness and what is holistic security and holistic privacy or public sharing of information. And I think that's a much greater debate. It will end up in a geopolitical debate in some format, but from a financial services perspective, it honest to me means that we will have a much greater permanent focus on financial preparedness, financial security, financial wellness, the health of your wealth, the health of your financial understanding in terms of literacy and engagement. It's incumbent upon all of us in the industry to promote and actively crystallize those points of view, because it will change the dynamic of how financial services engages going forward.
Okay, mine's brief. I would say trust has changed. Historically, in the world of financial services, we've trusted the oldest companies, the biggest companies. And now it seems to me that people want to trust the most open companies, the most ESG companies, the most transparent companies. It goes the same with social media. It goes the same with news. People are more likely to trust a open source blockchain than JP Morgan to transfer their money at this point. Like, it's the world in that way has changed a lot. People's trust of whether or not the person next to them has been processing or practicing social distancing, all the way we trust things are moving away from old brands to new brands and digitization.
Great point.
Perfect. Thank you so much. So listen, I want to leave it up a little bit for questions. If there's, I know we're running out of time. If there's like one question out there, Michael Lee, third Michael here. Any question that that has come up?
Yeah, actually, a lot of the questions that were asked were then like, yeah, you guys kind of got to it immediately afterwards. So great for that. I think one question that came in kind of at the tail end is what strategies have you found are most effective for building that trust? I guess the person is kind of getting, is it the messaging or is it something else? I don't want to put words in their mouth, obviously.
So I think we both answered it, right? Like, yeah. Michael's made it very clear. It said authenticity. I think it's a combination of authenticity with consistency, law of large numbers. Right? They want to see you be authentic, but they also need to see you show up over and over and over and over and over and over again. Right? It's not an accident that it says ETF Think Tank 9 times behind me. I think it's intentional.
I think we'll get back to the idea of trust but verify, and verify will have some form of credibility orientation, credibility scoring, or credibility logic around it. And I think that humans have an innate ability to look you in the eye and understand that you're lying right away. So how do we embed in that? How do we embed technology in that? How do we embed the enabling methods, enabling mechanisms to what is the nature of trust? What is the dynamics of trust? And how does that evolve over time? I think it's an exciting journey actually ahead. And I'm personally working with a range of fintechs in that space. And I think they're just tremendous, the capabilities that are coming down the pipes on that arena.
Perfect. So listen, thank you so much, both Michaels, for your time, for your insights. And I thank you for the audience. I hope you'll find it very interesting. We will follow up with, we'll send the recording and the video of the webinar, just in case, you missed something. And also, from Qnary, we're also offering kind of like a free digital analysis of your guys' social media presence. So feel free to ask for it. And we will certainly be more than happy to provide. And thank you, Michael Venuto, Michael Spellacy. It was an honor to have you here. And stay safe, stay healthy, and have a great week. Thank you all.
Thank you. Thanks. Bye-bye.
Thank you.